Good morning, everyone.
Good morning, Professor.
Hey, good morning, Angelica. How's everybody else? I see. Okay, we're having 7 people present, right now, and I see. I'll just quickly check in the forum. Um, we have 8 people in the forum, and we have exactly 8. Okay, good. That's the numbers are matching. So let me um, start. Let me share my screen with you. So there you go. Um, all right. I just restarted the computer, so a lot of things are not there. Let me just. Uh, all right. So one thing I would like to I would one thing I would like to let you know is that we are already into topic 2, right? Um, but we are, kind of behind, right? The collaborate session is behind our main lecture, but that's inevitable because the collaborate session is only the reflection, right? Review and reflection of the topics that were previously covered. But let me. Um, so we are into topic 2, and since last class, I believe since Tuesday, we are into topic 2. So you must have caught up all the way. I mean, as of Tuesday, you should have caught up all the way uh, with. You should have been caught up with, financial statements intro 1 through intro 4, right? And today's assigned videos are um, financial statements intro 5 through 7. Okay, and let me also check how many people are here now. So there are 12 people, and two are still missing in the collaborate. But it's important that you also, attend the collaborate session, because as I'm speaking, the information like this, information of this kind, whether uh, where we are and how far you must have caught up, with how things like that. You are not constantly reminding yourself of the progress of the class, but through this, I'm reminding you of where we are, right? And for those people who are just, who think attending collaborate session is everything, this is a wake-up call that we are not actually, where we are in the collaborate session is not where we are according to schedule. According to schedule, the main lecture have gone already to uh, financial statements. Okay, and another thing is that everybody's aware that uh, there is a ROI practice test, right? This is this is going to be available from tomorrow. It's not visible to you. It's right. This is grayed out. That means it's not visible to you. Um, so from tomorrow, it will open, and you have 180 minutes. So please, be mindful. Okay, please be mindful. All right, and although we are kind of behind schedule, but I mean, Collaborate session is behind schedule, but it is crucial. I mean, we can't. I have to wrap this up because monetary policy is a very important part of the ROI and how the Federal Reserve, how the Federal Reserve implement the monetary policy. That's quite an interesting topic. So we'll have to address that. Okay. Excuse me a second. So I believe in our last class we talked about we discussed different types of different classifications of interest rates, and we talked about how simple interest rate works and then we talked about the correlation, inverse correlation between the interest rate and the economy. And basically, this inverse relationship starts with the interest rate, and the Federal Reserve. Federal Reserve basically changes the baseline interest rate or benchmark interest rate, which is called Fed funds rate, and from there on, the rest of it works in chain reaction or ripple effect. So first of all, Fed funds rate is not the federal funds market. And the rate that is used in the federal funds market is the Fed funds rate, and federal funds market is not owned or run by the Federal Reserve. Federal Reserve Federal Reserve is only a central bank, and as a central bank, Federal Reserve is the regulatory authority in commercial banking, and the lender of the last resort. Meaning, when the commercial banks cannot borrow from each other, then they will come to the Federal Reserve as the lender of the last resort. But lending and borrowing money in this context is not really it's only a metaphor. They don't really lend or borrow money in physical sense. Okay. Now, and as the ultimate authority in the monetary policy, Federal Reserve sets the target for Fed funds rate target. So you see this graph, all along this graph, right? In this graph, all along, you see the title is Fed funds target rate. That means, it's the target. The reality may be different from it. So what that means is Federal Reserve sets the target and tries to bring the actual market Fed funds rate, bring the actual market rate close to the target. Okay, so this may sound like, oh, why don't they just, say, let the rate be, 10% from tomorrow? Can't they issue a decree or edict like that? No, no. First of all, Federal Reserve is not a government branch or government agency. Federal Reserve is actually literally, it's a central bank, but it's not a government branch. It's separate from government. Two, we are in a free market economy. In a free market economy, nobody sets the price. Okay, you may have heard of this. In a market economy, market sets the price, right? It's not determined by any edict. Okay, and you might wonder, what does it have to do with the interest rate? What does it have to do with the Fed funds rate? Again, if you think about it, I don't know if you ever thought about this, but interest rate is also a kind of price, right? Has anybody ever thought about that? We have 12 people here, but how many of you have hard time understanding what I said? Interest rate is a kind of price. If it is a kind of price, then it's the price for what?
It's basically, Julian speaking, is it the price for getting something?
Getting what? I mean, interest rate. Okay, what is that something?
If it relates, for example, interest rate on borrowing, is it the price for borrowing the money?
Yes, you're right. Yes, interest rate is the price for borrowing, of course. So, yeah, Jodianne. So, yeah, I'll give you 0.25 for that answer. And today is 23, right? 23rd. And this class is section fnb100, section 1101. Okay. All right. Yes, interest rate is also a kind of price. It's the price for borrowing money. So, as the saying goes, all prices are determined by demand and supply in a free free market economy. And no, if some government authority sets the price, it's not going to hold. It's not going to work. Why? For a simple example, suppose they say this is a command economy. So, suppose if we imagine that we are in a command economy, and then government sets price. So they say, government said, let the gas price be $2 from tomorrow, $2 per gallon. Now, what's going to happen? I mean, currently gas prices, three something, right? 350 something or three, depending on where you are. But generally in New York, it would be something like 355 or above. In New Jersey, it's a lot cheaper. It could be about 20 to 30 cents cheaper, not a lot cheaper. But that's the going rate. That's what that's the price determined by the market forces, demand and supply. But if the government imposed, a $2 per gallon, what would you expect? first of all, this is cheaper than the market price, so there will be a lot of cars lining up in the gas station to fill gas, right? First of all, you can imagine that because gas is suddenly cheaper. But then, do you think the gas station will have gas? Hmm?
No, it won't.
No. I mean, they will have gas, but they are not going to sell gas, right? Why? I mean, the gas station will just put out a sign, out of gas. They have gas. Although they have gas, they will just put out a sign, out of gas, right? Why? They wouldn't want to sell it at lower than the market price. Just because the government, set the price at $2, the gas station is not happy. There's no gas station that's happy to sell the gas for $2 per gallon. So what they will do is they will put out a sign that says out of gas, and behind the doors, behind the closed doors, back through the back door, they will sell gas. I mean, someone comes along, and through the back door, knock on the door, do you have, and asks, do you have gas? And they will say, how much are you willing to pay? How much, I'll pay you whatever you ask for. I'll pay you, whatever was, the price before the government set price. So if he's willing to pay $3.55, then the gas station will sell gas. Of course, this is underground economy, and in such a system, if they are caught, they can be in trouble. But if they can do business, basically, underground economy is basically, something, carried out in secret, basically. So eventually, everyone who is willing to pay market price of $3.55 will get gas, but anybody who doesn't want to pay $3.55 won't get gas. That's the market price. Okay, so the command economy isn't gonna work. Of course, if they hold you at gunpoint and you violated the law. The law said the gas must be $2 per gallon. I mean, a lot of gas stations will go out of business. Either they go to jail or go out of business. But that kind of economy won't work. So that's why we have market economy, free market economy. And in a free market economy, the market sets the price. And that's basically what the economics textbook says. And it really is the case. So even in the interest rate, the same principle applies, right? You cannot dictate the interest rate, right? Any central authority, government authority, cannot simply dictate the interest rate. So they work through the market system. So how do they work through the market system? Now, it's basically open market. It's called open market operation, right? Federal Reserve has three tools for monetary policy, and the monetary policy is basically, excuse me. Monetary policy is basically, the central bank moving into the central bank, increasing or decreasing money supply throughout the economy, right? But that works through the market system. And think about it. It's through the interest rate, right? It's through changing interest rate. If interest rate goes down, borrowing goes up, and if borrowing goes up, money supply throughout the economy goes up. I explained the mechanism, before, I believe. I mean, I have 4 sections of this course. So in one section, if I said it in a couple of other sections, then even I may remember that as I remember that as already being discussed in this class as well. So I'm not exactly sure if I talked about it, but everyone understands this means money supply, right? Is that right, everyone? Do you recognize money supply?
Yes.
Okay, so then I must have talked about it. I
Yes.
must have talked about it. Yeah. Yeah, if interest rate goes down, it's easier to borrow, right, and easier to pay back, less burdensome. So businesses, borrow more and invest in their expansion, and as they expand, that means they hire a construction company to build new plant, and in the new plant they will put in new production equipment, right? And therefore, construction company gets paid, they pay their workers, production equipment manufacturer gets paid, they pay their workers, workers spend money, you have bigger production capacity, you hire more workers, you pay workers, workers spend money, they all have feedback that increases the money supply throughout the economy, and that has the positive feedback into the economy. So the output of the economy goes up, and it's exactly the opposite when interest rate goes up. So through changing interest rates, Federal Reserve increases or decreases money supply. That's monetary policy, and they have 3 tools. Basically, they have 3 tools. I'm jumping around the slides, but the primary tool is open market operation. Second one is discount rate. Third one is reserve ratio. And generally they work through the open market operation. But before explaining what is open market operation and how it works, we'll need to think about what open market means. Market in this case, in this context, market means bond market, bond. And what is a bond? I'm going to get to that. Basically, you've heard of stocks and bonds. You know what stock is. Generally you have some rough idea, but you don't have very clear and exact idea. You also heard about bond. You just have a rough idea. So I'm going to talk about the bond. But open means it's open to anybody. Anybody means any institutional investor or individual investor. Okay, individual investors are obviously individuals like you and me. If you invest, you may be using Robinhood or something, but what they call retail investors, and then institutional investors are big money movers, like big Wall Street firms, asset management firms, like Goldman Sachs, but they're also investment bank, and but also doing asset management. BlackRock, what's that? BlackRock. There's BlackRock and Blackstone. All these. I don't know why they have. And Renaissance Capital. Renaissance Capital is headed by a mathematician, and he made. I forgot his name, but he made. Well, anyway. And then hedge funds, insurance companies. These are all institutional investors, and they are they have huge, money, a huge amount of money. They have huge funds that they handle, they manage, under their, in their portfolio. Um, so obviously, institutional investors are bigger forces in the market, and also it's open to anybody, as I said, institutional or individual or institutional, domestic or foreign. So foreign investors can also participate in the U.S. securities market. That's why it's called, open market. And operation means, Federal Reserve goes into the bond market and buy and sell securities, mostly, treasury securities, to increase or decrease money supply, and as a result, rates change. So if you think about it, we need to first understand what bond is. Bond is basically a debt instrument with standardized features, so it can be easily traded in the market. So when we say a debt, you think about a loan, right? And then the size of the loan varies, depending on your needs. So if you need, a $5 million loan, you think about one just big lump sum, $5 million. Suppose you buy a house and you get let's say the house is $1 million. After down payment, let's say, you made a 10, let's say down payment is zero. That's not possible because, then, there's no reason for the bank to lend you money. Because if you borrow 100% of 1 million and buy the house, then you have no stake. You have no stake in that house, right? None of it is yours, right? Then, why would the lender let you live in the house? They will simply own it right away and rent it out, right? You wouldn't have any stake in the house, so you will have to have, some stake in the house. So there must be some down payment. But then, just for thought experiment, just for the simplicity of our thought experiment, let's say you borrow $1 million, entire $1 million, with 0% down. Then you think about, you're thinking, so it's 1 million, so you get a lump sum check, a big check that says, $1 million. Or, as I said before, these days they don't, lend you money by issuing a check. It can be direct deposited into your account. So you will think, it's $1 million. I get a lump sum deposit of $1 million. Yes, if as an individual, if you borrow, that's going to be the case. But when businesses borrow, they don't borrow from the bank. They can borrow from the bank, of course. Sources of business credits, if businesses borrow, right, credit means they are borrowing. They can borrow from institutional lenders like banks, right? Or they can borrow from the bond market. They can sell bond in the bond market. So bond is a debt instrument with standardized features. So standardized feature is something like, face value of $1,000. So basically all the bonds have face value or maturity value of $1,000. Now, face value, maturity value, par value, redemption value, they all mean the same thing, right? If you buy a one-year bond of company X, right? That means 1 year later, the company will pay you back. If you buy only one bond, single bond, that means you're paying something less than $1,000 or more than $1,000. The selling price of the bond is not exactly $1,000. It could be less or it could be more, depending on what? Depending on how much interest it pays. Okay, so the bond pays, but 1 year later, that means the maturity is 1 year. So that means 1 year later, you will redeem $1,000. And that's called, that's why it's called redemption value or par value or maturity value or face value, because on the face of the bond, it will say $1,000. Okay. And the interest it pays is called coupon rate. Coupon rate. Interest it pays is coupon rate. So if the coupon rate is 10%, then during this 1 year period, you will receive $100 interest, but they paid in two semi-annual payments, two semi-annual coupon payments. Okay, so at the end of the first 6 months, you will get $50. At the end of the second 6 months, you will get another $50, and also the par value of 1,000, because that's the end of the second half. The end of the second 6 months is the end of the year. So maturity was 1 year, so you'll get 1,000 and then $50. That's the case. That's what happens. And time to maturity can be, up to 30 years. It can be, bonds have maturity generally. Maximum length of the maturity is 30 years. That doesn't mean, there can be no bond beyond 30 years. I mean, some special bonds can be can have maturity longer than 30 years. Especially in the 19th century, early 20th century, they issued bonds that have very long maturity. War bonds, had very long maturity. But these days, that's not the convention. Conventionally, the longest maturity is 30 years. Shortest maturity is 1 year, right? Bonds must have maturity above 1 year. Below 1 year, right? It's called commercial paper. It's called commercial paper. Okay? If the maturity is, 30 days, 60 days, 90 days, it's called commercial paper. So think about it. If it was you borrowing mortgage for a house and you borrowed $1 million, it's just a lump sum, $1 million being deposited into your account, or a check, right? Written, written in the amount of $1 million. But if a company borrows $1 million, what they will do is they will sell 1,000 bonds. It will be more or less, 1,000, because the selling, depending on the selling price, right? If the company wants to raise $1 million, they will sell about 1,000 bonds in the market. Okay, because each bond is, selling for around 1,000, right? So the 1,000 times 1,000, that's 1 million, right? So bond is, if you buy bond, you are called a bond holder, right? You buy bond, you're a bond holder, or creditor, or debt holder, or lender. they all mean the same thing, right? If you bought bond, of course you're the bondholder, right? You lended money, so lender. Lending is the same thing as credit, right? Credit is no lending, basically, right? So creditor, you're the creditor. And you hold the debt of the company, so debt holder. All right, does that make sense? That makes sense, everyone? Okay. All right, thank you, Jody Ann. You pay attention. I don't know what's happening with other people. They're just, quiet. I don't know if they're listening or they're following or, not participating, just logged in but not participating. I need some confirmation that you are following and understanding, right? Otherwise, I'm just like, shouting into the, empty, hollow cave, right? Now, so bonds can be also classified as, depending on who is the issuer, who issued the bonds, and the maturity. So actually bonds, who can issue bonds? First of all, companies, right? Businesses, and then federal government and local government, right? Federal government can federal government can borrow money, right? Federal government can borrow money by issuing bonds, by selling bonds, and which the window of the federal government's borrowing arm is the Treasury Department. Okay, and the window is usually the Federal Reserve. Federal Reserve is the window for handling this. I showed only a Treasury and corporate bond example. Okay, Treasury and corporate bond example, but actually, I didn't include, municipal governments like, state governments, city governments. State and city governments can also sell bonds. Okay, they can also, because they need to borrow money, for public projects. And why do they have to borrow? You might wonder, why does the U.S. government, why does the federal government have to borrow, or why does the local government have to borrow? I mean, don't they have, income? I mean, don't they have, budget for all the, their expenditure and, their expenditure and public projects? Yes, they have income, and their income is basically tax revenue. Think about it. Federal government and local governments, their income source is tax revenue. But sometimes their tax revenue is less than their planned budget, right? So, and you all understand U.S. government has a lot of, debt. Government debt is also called national debt. And debt of the U.S. government is pretty much, the size of the U.S. GDP, or U.S. GDP as of 2020 was $21 trillion, and the total size of government debt is about 21 trillion or more. You might wonder, is that possible? Can we do? Yes, we can do that, because you pay the debt, you pay off the debt over time. You don't pay off the debt in a single year. It is paid off over 30 years, or because that's why they have 30-year bond. Okay, so I didn't include I didn't include, municipal government in this example, in this table, but because, but it's pretty much the same thing. I didn't include it there because only the municipal bonds have different face value. So Treasury has three types of bonds depending on the maturity. And if the maturity is short term, it's called the Treasury bill, T-bill. If the maturity is long term, and this is an interesting thing, long term, how much is, what is long term? In finance and accounting, the line between short term and long term is very clear. It's drawn on 1 year. Any maturity longer than 1 year is long term. Any maturity less than 1 year is short term. And then is there a difference between long term and very long? No, this is only my classification, right? They just call it long term, but just for Treasury's, classification, because Treasury bond that has maturity between 1 year and 10 years is called a Treasury note. Treasury note. Okay. And Treasury security, and it's called collectively, they are all called Treasury securities. They are classified as T-bill, T-note, and T-bond, Treasury bond. But if you call them collectively, Treasury securities, right? So the Treasury securities with the maturity between 10 and 30 years is called Treasury bond. And corporate bonds generally have, of course, it's not really not applicable. Corporate bonds with maturity above 1 year is all called, bond, and they can have 30-year bond. The only reason I put not applicable or not available, it's not available. I just use this to refer to a classification like very long term, right? Because bond for corporate bond, there is no distinction between 1 to 10 years and 10 to 30 years. They just don't have any distinction like that. They're just called bond. And then under 1 year, commercial paper. And then depending on classification, if we classify it by whether they pay interest or not, it's classified as coupon bond and zero coupon bond. Coupon bond means, coupon, I told you, coupon means bond's interest. Bond's interest is called coupon. And it's not, if it is not paying interest, non-interest bearing, then it's zero coupon bond because it's literally zero. Depending on, so I told you the bond's selling price of the bond can be greater than or less than the par value. The par value is 1,000, right? How come? It all depends on what's the coupon rate. If the coupon rate is greater than the prevailing market rate, if the coupon rate is greater than the prevailing market rate, then it will sell above par value. And it's called a premium bond. And if the coupon rate is lower than the market rate, prevailing market rate, then it's called, it will sell below par value, and it's called discount bond because it sells at discount. Now, let's think about it. Why would a premium bond sell above par value. I mean, the name already means, it's selling above par value because the name is premium bond. It sells at premium. And if you think about it, it's a logical thing. It's a very logical thing. First of all, let's say the prevailing interest rate in the market is 5%. Prevailing rate in the market is 5%. But this bond pays 10% coupon interest, 10% coupon interest. What's going to be the demand for such a bond? Anybody?
Could you please repeat that?
Yeah. Let's say we have a bond A. Company A is selling their bond, so call it bond A. This bond is paying 10% coupon. This bond is paying 10% coupon interest rate. Okay, this bond is paying 10% coupon interest rate, and the prevailing rate in the market rate is 5%. What's going to be the demand for this bond?
It's going to be a high demand for it.
Yeah, that was going to. Who was this? Jodianne?
Yes.
Okay, Jodianne, you'll get another 0.25 for that answer, right? Yes, it's going to be. There's going to be a very high demand, strong demand for such a bond. Why? Wouldn't you? I mean, if you put your money in the bank, you just get 5%. But if you buy this bond, if you put your money into this bond, let's say you have $10,000, you put $10,000 in the bank, you just get 5%. But with $10,000, you can buy about 10 bonds, about 10 of them of company A. You're lending money, you're lending $10,000 to this company, and they are paying you 10% interest. Wouldn't anybody do that? Huh? Isn't that right?
Yeah, of course.
Yeah, of course.
Yeah.
Why wouldn't you earn twice the interest? And of course, one thing that bothers you here is if you put your money in the bank, it's 100%, risk-free. So the question is, what is the risk level? What is the default risk of this company? I mean, if this company is if this company is very low risk, right? If this company's risk level is very low, then that means their credit rating is very high. If this company is like AAA, they are very safe. They are as safe as the bank. Then you have no reason to say no to this company, right? You'll buy the bond, and 1 year later you'll have 10% interest. While if you had put the money in the bank, you would have only 5% interest, right? Oh, then of course, this is only a hypothetical situation. The next question is, why would such a company pay such high interest, right? Why such high interest? I mean, if they are as safe as the bank, then they can just pay 5% or slightly better, 6%, even 6%. It's an incentive. I mean, you would have an incentive to put the money into this bond rather than in the bank because it's still 1% higher is still higher. Isn't it right? 1% higher is still higher.
Yeah.
Depending on whether, so then that explains automatically what kind of bond will sell below par value. The bonds that pay lower than market interest rate will sell at discount and below par value. That's why it's called discount bond. Okay, because the demand will be very low, right? I would rather put my money in the bank rather than putting that into the bond of this company, right? If the bank pays 5%, but this bond pays only 2.5%, then I have no reason to buy this company, right? So that's the reasoning, that's the logical reasoning behind it. But also you will see the mechanism later. We're out of time today, so we'll have to continue this next Tuesday. But please, remember we are already in topic 2, and as we this weekend, the practice test that is pretty much wrapping up everything about the first topic. Although we will continue with the open market operation in the next class, but officially topic 1 is over, right? We're already into topic 2. All right.
Professor,
So
quick question.
yeah.
Is the quiz like the last one? It starts on Friday and ends Sunday?
Yeah. Go to the announcements and you will see the instruction is there.
Okay,
The
thank you.
announcement is there. It says, yeah, you have 3-day window and you have 180 minutes.
Mhm.
Okay. Once you start, you got to finish it within 180 in one sitting, right? 180 minutes within one sitting, right? I'm
Yes.
just,
Yes.
I, yeah, I'm tongue tied because, I'm running out of time. um, Okay, so
Professor, I have
find
a
the
quick
best
question as
time.
well.
Hmm?
Jodian speaking, I have a quick question as well. For the
Yeah.
last practice test,
Uh-huh.
did you grade those? Because I'm seeing a 0 and I don't know what's going on with mine.
Yeah, it was great. And then didn't you see um, the result was posted there. This is the result. Have you checked it out?
Oh no, I was looking in the grades on Blackboard.
Uh, on even on the blackboard, you should be able to see it. You should be able to see it, right? Feedback and everything. Okay.
Okay, thank you.
Okay. All right. You're welcome. All righty. I'll have to sign out. Have a good weekend and good luck with your practice test. All right.
Have a good weekend, Professor.
Take care, everyone.
Great week. Bye bye.
All right. Take care. Bye bye.
Goodbye.
All right. Goodbye.